Good afternoon. We are going to discuss the accounting for journal entries and calculations for notes receivable that have matured in 12 months or less. So these, when a note is 12 months or less, we're not required to use present value or time value of money. And so this note, and I'm working exercise 14 if you're following along in the book. Exercise 14 said on June 30th, we give a customer $30,000 and they sign a promissory note agreeing to pay back principal plus 6% interest. Okay. And now the maturity value, so we record a note and give them cash. And the maturity value of this note, principal, $30,000 principal plus interest on $30,000 at 6% for 9/12 of a year. So notice this is always a fraction of a year. The time maturity value equals principal plus principal times rate times time, $30,000 principal plus $30,000 times 6% interest for 9/12 of a year. So they're going to have to pay us back $31,350 next March. So the note runs from June 30th to March 31st. It's a 9-month note, not an entire year, 9 months, 9/12 of a year. December 31st comes around and we're going to accrue interest. We're going to accrue 6 months interest from June 30th to December 31st. And interest is principal, the $30,000 principal, times 6% interest for 6 months of a year. So we're going to accrue $900 interest for the period from June 30th to December 31st. Now on March 31st, the note matures and they're going to have to pay us. But before they pay us, I want to get all the related accounts, the interest receivable, up to date. So on March 31st, I'm going to accrue interest for January, February, and March. That's $30,000 times 6% times 3 months. So I'm going to accrue $450 interest. Now, please notice that the interest we calculated for 2015 on December 31st, that $900 interest appears on the 2015 income statement, which is then closed to retained earnings. Okay. Whereas the interest we calculate for January, February, and March, that relates to the 2016 income statement. So these are two different interest revenue accounts, unlike the interest receivable, which is the same account. It just keeps accumulating. So then on March 31st, they're going to give me cash. How much? $31,350, the maturity value. And when they give me that cash, then I will forgive the interest receivable of $1,350 and the note receivable of $30,000. Hopefully the entry balances. It looks like it does. I hope that helps you with notes receivable, and I hope you have a good day. Thank you.